Growing a business is one of the most thrilling and challenging things you'll ever do. You might have a game-changing product or service, but how do you transform it into tangible success? Well, that's where investment and finance comes into play. From the birth of the stock markets to Silicon Valley's innovations, savvy investors and entrepreneurs have been reshaping industries and rewriting economic rules. Whether you're starting out in business or an SME scaling up, join us as we give you access to the worlds of venture capital, private equity, grants, loans, bootstrapping and crowdfunding. Get the insider view from VCs about what lenders are looking for. Get crucial tips on pitching from independent business advisors. And hear the raw truth from founders and CEOs about what it really takes professionally and personally. Smart investment is about more than financial returns. It's about driving innovation, developing teams, creating opportunities, and building sustainable businesses where everyone benefits. Welcome to the future of finance. Let's meet our experts.
Hi, I'm Charlotte Scott. I'm Senior Investor Relations Manager at Innovation Super Network, and I'm here today at the Catalyst building in the Helix in Newcastle, and we will be discussing different ways that businesses who are looking to start up or grow can raise finance, the different types of finance out there, and the various things to look for and avoid along the way. Innovation Super Network is a not-for-profit based in Newcastle in the northeast of England, and it really exists to help support innovation in the region, connect startups and small businesses with the support and the finance that they need to grow, with the ultimate goal of sort of regenerating the region.
I'm Chris Green. I'm the CEO of CellRev. I lead a biotech company that are providing processing solutions to cell-based manufacturers. So we use enzymes in a really novel and ingenious way. So we apply those enzymes to achieve things in biomanufacturing that others cannot do, and that allows us to reduce the costs of the manufacturing process, to improve the stability of the manufacturing process, and ultimately enable access to these treatments, these vaccines, in a way that others can't.
Hi, my name is Joe Headley. I am the co-founder and chief executive of Nunabio. We synthesize DNA at scale, and we use DNA in a wide variety of different places, everything from batteries to computers to therapeutics and diagnostics. The most obvious use case that people will have heard of is the use of DNA for COVID PCR or even the COVID vaccines.
My name is Sophie Gowlin. I'm the Accelerator Manager for NatWest Business. So the Accelerator programme is for tailored support for businesses to help them scale and grow. Business coaching is predominantly my main role within the Accelerator programme, and what that allows businesses to do is to gain access to one-to-one and group support to help them with accountability, clarity, and making sure that they stick to their goals.
I'm Alex Buchan. I'm an investment director at North Star Ventures, and we're a venture capital firm based in Newcastle. We've been around about 20 years, investing in early stage businesses and helping to transform the ecosystem from the old economy into what the Northeast is today.
I'm Rohan Sivajoti. I'm co-founder at NextGen Planners, and NextGen Planners are a community of around about 1,800 or so within the financial services sector within the UK, who are there for the advancement of the profession and themselves.
Finance is about more than money. It's about investing in people.
You're entering into a relationship which could possibly be longer than most marriages. And you need to have a thought for the whole cycle of that investment.
Because if you bring an investor on, they're going to be on your cap table. Essentially, they're going to be a shareholder in the company for a long period of time.
And when you're going into an investor relationship with someone, it requires both parties to really understand the perspective of the other and find a really healthy compromise.
Team is really the vital component, and everything else is actually secondary, because if you've got a great technology but you can't build it, it doesn't work. Finance is only part of it, obviously a really important part of it, but it is much about the people around you as anything else. We're very uncomfortable with sole founders because it's really lonely being a founder CEO of a business. You need people around you, you need an ecosystem around you, you need a team.
When you go into a fundraise, my experience is that you're not going to be successful on your own. You need the support of your co-workers, you need the support of your advisors, your board, but also your family. The people that you bring into the company quite rightly have a lot of influence. That is both a positive and can be a negative thing. If you don't set the compass entirely right, you're going to end up in the wrong place.
I think it comes back to the trust and the relationship that you have with them, because if that breaks down and there's a misalignment on where the business is going and where they wanted the business to go or what was sold to them at the point of investment, then of course the relationship can sour. However, I would say, aside from the people element, investment is all about money. It's just the flow of capital. Yes, I love the altruistic view that people are so important in all of this. The reason an investor invests in your business, and I think it's important that all founders, all entrepreneurs, all CEOs understand this, is ultimately because they want to make more money. And your job is to make them more money, and it's as simple as that.
What tips have our experts got for growing your business?
If you're looking to grow a business or even to start a business, it is probably the hardest thing you're ever going to do in your life.
Nothing in building a business from scratch comes easy. At every stage of building, there will be countless hurdles and challenges.
One thing that I think will always stand any business in good stead is to establish good governance from day one, just in the same way that it's good to establish good operational practice from day one. Governance, particularly around the boardroom, is very important. It's something that we took very seriously. It's very important to have that objectivity, particularly if you've never raised before. It's something that we took advantage of, and it's hugely benefited us.
There's lots of different principles that are aligned with growth. The difference between growth and scaling a business is that we're wanting to increase that revenue, but we're wanting to keep the cost low or to a minimum. So there's lots of different challenges that businesses are going to face. That can be to do with selling, leadership, funding and accessing that funding. And so we want to understand what those weaknesses are and then tailor the growth around that.
Most people tend to think, right, we've got 3 months of cash left in the bank, and at this point we're going to go out to investors. But that is pretty much the absolute worst time that you could approach an investor, because you've just sabotaged your own negotiating position. So what founders tend to do is they will wait until they have a very positive trend in their revenue or in their customer base, and you actually are very healthy financially, and you can demonstrate that sort of the year-on-year growth is really positive. You're then in a really strong negotiating position to say, well, look, if we extrapolate this growth rate out in 2-3 years, this is what we're going to be worth.
If you need to close by the end of the month and the investor doesn't have to, you have to accept what the investor wants, right? So the longer that you can get that runway and the more that you can sort of extend the life of the business through various different means, the better chance you've got of getting the right deal for the business.
You have to make the case to yourself and to your investment committee that any business you invest in has got the potential for a super return. This is driven by the fact that you have a portfolio of businesses, a number of which will fail, some of which won't live up to expectations, and some will do really, really well. And by the blend of these, you end up with a return on the fund, which justifies the investment of the people who put money into the fund itself.
I don't think founders are always the best people to run a business. I think that often founders will find themselves running a business based on a passion that they've made into a business from a hobby. So often they aren't the people that can actually lead a team. They might not necessarily be experts in finance. So I think that the foundational needs for business owners is considering their life holistically, not just within the business. So are they eating well, sleeping well, are they exercising? And those things are going to really help support their performance both in the business and outside with their family lives.
You've got to be adaptable, you've got to be flexible. It's having, I guess, that sort of nous, not to stick too hard to a plan, but to identify when opportunities come up. And it's just part of the whole growth journey is that, you know, the plan that you wrote 3 years ago never looks like where you are 3 years to today.
The key to investment is storytelling. So how best to pitch?
The more you pitch, the better you get. It's all down to practice, and it can be really daunting.
It is so easy when you're running a business and saying the day-to-day to believe your own hype. Like, we think we're doing brilliant. They will think what they're doing is the best thing that nobody's ever heard of. Ultimately, investors won't see it that way.
The first set of investors you go out to, or almost a test set of investors, you won't get it right first time. My view is that pitching is a depreciating skill. The more you do it, the better you get at it. The less you do it, the worse you get at it.
If you are invited to pitch, You will inevitably put together your 14, 15 slide pitch deck. It is only brief enough to essentially entice an investor to have a conversation with you. When you go and pitch them, there will inevitably be questions and feedback. Really make note as a founder which questions those are, especially if you find the same questions coming over and over again, because that normally means that you've missed out some really critical information in your pitch deck.
Each time we had an interaction, we took the information, we did what's called a after-action report and assessed how we answered those questions and how we could better answer them.
So something we've done continuously through every investment round is constantly look at how we can tell our story better, because that's what raising investment is ultimately. It's storytelling. And I honestly would say we change or at least perfect our story, or have perfected our story over the last 2 years, at least every quarter.
And it's about the story that we tell ourselves as well as what we put out there. And the story is always evolving and changing because the business changes, you come up with new avenues, new revenue streams, new market focuses, all this kind of thing. The story is always evolving.
Pitching can feel like quite an uncomfortable thing for business owners. It can feel very stiff and unnatural. And one of the things that we want to focus on is make sure that business owners feel really comfortable to talk about their business and the value that that provides. We will host a bi-weekly pitch club and they'll pitch to one another, offer feedback. We'll bring in pitch panels that can ask questions and challenge the entrepreneurs as well. When you're raising finance, you are not alone. There is a range of support that's available for you, whether that's voice coaches to support with your pitching, all the way through to finance support, legal support, IP protection. There is a huge array of support available. What I would recommend is that you reach out to somebody that has got a good network and you are not shy in asking for their help.
A business coach can be really helpful, not just in preparing your pitch. They can help you in sort of strategizing for your business in other ways. Different business coaches offer different services. I definitely recommend going with a business coach who has either worked in finance in some capacity to sort of support you through that process.
Now let's look at the 5 different types of finance available to businesses. Bootstrapping. This involves using your own personal resources. Grants. These are often provided by the government or other institutions, and they are high-risk investments. Debt. This includes bank loans, low risk for lenders, but you do need to repay with interest. Equity. This involves selling shares of your company to investors. And crowdfunding. This allows businesses to raise capital, but from a large number of individuals. Let's find out more. Let's start with bootstrapping.
Investing of your own money tends to be called bootstrapping. And we hear that a lot in relation to startups in particular.
It does present a personal challenge, particularly if you're not a wealthy individual.
You can invest your own money at any point if you need the cash in the business. There are many different ways that you can do it. If you did decide to secure a loan or some kind of investment from your friends and family, we often call this the 3 Fs, friends, family, and fools. The reason that fools is in there as well is because it just tends to be so risky. In the beginning, founders can get very, very enthusiastic and everyone believes in them and they're really good at selling their vision, but delivery and execution of a business can be really hard. And should that business grow or you bring in another investor or another finance provider, whatever it might be, it can get quite complicated if you haven't gone through all the necessarily legal processes to really formalize that relationship. And it can also create some real tension between your friends and family or your acquaintances.
We remortgaged our house so that we could extend the runway of the business. I think it shows a huge level of commitment to the business, particularly when you're asking others to commit.
Doing something drastic like remortgaging your house or putting thousands of pounds of your own savings in is a pretty clear sign that not only you are very confident in your own vision and your own ability and skills and the skills of your team to deliver that business to be a success, but it also shows just how incentivized and committed you are and motivated.
So I guess when we wanted to have this investment in the business, we looked at the various VC, PE route, all of that kind of thing, because we had some offers for quite large shareholdings, but just didn't want to do that. First was to bootstrap it, continue to bootstrap it, put our own money in. The purpose for us was to get our community on side, so to get them as investors in the community, that was really important to us, and that wouldn't have allowed us that.
What founders can do to educate themselves, they could potentially use a site such as the UK BAA, the UK British Business Angels Association, where they could become members on there, and there are courses that you can do to really understand the roles and responsibilities of an investor in a business, the sort of documentation that you would expect to see and what it means. But the most important thing is that individuals always do their own research, understand the risks, and understand that the company is going to deliver on what it says it will.
Now, let's explore the world of grants.
Grants are not easy to come by. You have to go through a very detailed application process.
First thing to consider when you're going for a grant is that it is not actually free money.
And even if you've written the best application, there's a chance there might not be funding of it at the end.
So there will be sort of very local, normally a few £1,000s, local grants that you can go for. Then you have the grants up from that, which is sort of regional grants, which local authorities tend to manage, which also vary in size, all the way up to national. So you have providers like Innovate UK, who have various different grant and loan schemes going on at the same time, and definitely search their website because there are hundreds of them.
So the advantages of grants is they fund early stage research and development that investors probably won't want to. We've used grant money to allow us to take that step back and do earlier development work on a specific application, which is actually for therapies, so allogeneic cell therapies. This is a great example of why you have to be very specific with what you want to achieve and the time frame that you want to achieve it in to complement your existing business plan. You've also got to be able to very accurately present back the expenses that you have incurred before it's paid. And then there's a lead time on the payment. But unfortunately, you still need cash in the bank to be able to run the project.
Normally, grants are paid in arrears. That applies pretty much whichever level of grant you're going for. You will need to demonstrate to the grant provider that you have almost spent the money that you need the grant for, which can frustrate a lot of people. You normally tend to see grants which are match funded or some kind of aligned finance is raised. So it de-risks other forms of capital and finance. So grants can be really, really useful as leverage, but the specific sort of criteria for them can be really difficult to manage.
Another way of funding your business is through debt.
When you're going for a loan, it does tend to be quicker because ultimately the loan provider, the debt provider will want to see, can you make the loan repayments? Is the business option viable, etc.? And they can sign it off sometimes within a couple of weeks.
With traditional lending, you've got options for an array of products from high street banks that can support the funding of the business. One thing to consider with traditional lending is, of course, you're not giving equity away for the business. So once you've paid off that debt, you can still loan up to 100% of the business.
So when they are reviewing your financials, your business plan, they will need to see that you will, or the business will be able to repay the loan and the interest, regardless of how your business performs, and you will be liable to make those loan repayments even if the business fails. You do need to understand what possible consequences there might be for you as an individual and for anyone else in the business if you fail to repay that loan. Traditional banks, as we know them, aren't the only providers of loans. There are other people out there who can offer those products to you. You could approach the British Business Bank. They work with a whole host of delivery partners for the Startup Loan Scheme. So there are various different people that you can go to, lots of different terms and products out there, but always compare your options and ask lots of questions to make sure that you really understand what you're getting into before you sign anything.
Let's take a deep dive into Nunabio.
Over the last sort of 10 to 15 years, DNA has gone from being a biological study tool to actually something that we can make and use in a variety of different ways. Nunabio makes complex DNA at scale. We have a world-changing technology that can impact a wide range of people's lives, and we use it across a number of different areas, such as medical applications. The most obvious one is PCR tests for COVID and the COVID vaccine. So Nunabio was spun out of Newcastle University. It was already in receipt of a Innovate UK grant. which required matched funding. We obtained the matched funding from an angel investor, so we remortgaged our house. My wife was pregnant with our first child, who had been recently diagnosed with spina bifida, and I left my existing job and took the burden of salary away from the business to extend the life of the business and give it a better opportunity of success. And when you're asking other people to commit either financially or emotionally to your business and your idea, you've got to commit yourself, despite the emotional turmoil that you might go through. It was really important to us to show that by being a strong family unit, that we could go through 137 hospital appointments, 5 major operations, at the same time as 133 investment pitches.
Then there's equity.
Angel investment tends to be equity investment, i.e. capital or some kind of value into the business in exchange for shares. But they want to be involved in that business. They want to really sort of add support, to be on the other end of the phone should the founder need them.
They often come with a lot of value add. They're usually experienced and successful professionals in their own right, and they can help guide you.
So a more active investment or an active angel would be probably somebody that may be sitting on the board, could even be chairman. And if they're investing a substantial sum, they will normally know the field. So they're not a generalist, they understand the opportunity, they understand the business model, and they understand why it's going to present a big return for them, and that's why they would be heavily involved.
Yeah, I think angel investors can be a very good fit for an early stage business. They typically come with a lot of experience. As a result of that, can bring a lot of operational support in specific areas.
So unlike an angel investor who tends to invest all of their own money, make all their own decisions about who they invest in, a venture capitalist will be some sort of fund manager or investment associate, investment analyst, whoever they might be within that institution, and they will invest money on behalf of other people.
A venture capitalist is someone who invests money in business for a share of that business, i.e. an equity stake in that business. And once we've identified businesses that we want to invest in, we then work with them to build what the initial investment round will look like. We help them find co-investment. And post-investment, we spend as much or more time with these businesses, working with them on their boards, working with them about non-executives, helping, advising and guiding them on governance. When you're investing in early stage businesses, with a venture capital hat on, for want of a better word, you have to go into that believing yourself and being able to convince your investment committee that this business has the potential to give a super return of, say, 5 to 10 times the money invested.
When we think about approaching a venture capitalist, founders do need to understand that they are ultimately playing a numbers game, and they are also ultimately beholden to their investors and to their funders and the people that they are managing money on behalf of.
Something that I'm actually a really big fan of is strategic investment. So my view of strategic investment is investment that goes beyond value add in the sense that they can literally open up the market to you, or they can be your supply chain. There is mutual value across the two businesses in the sense that we can add more value to their existing product range.
My advice to someone who has built a business without taking investment is really think it through why you want that investment, because it does bring a series of controls around it which you may not be used to. And it may be something that you're uncomfortable with. You need to be very careful who you attract as an investor. You need to vet them just as much as they need to vet you.
I would encourage founders and startups or business owners, when they are having these discussions with investors, to do the research on the investor as well, because it has to be a two-way conversation, and both parties really need to feel that they're getting some sort of real added value out of that relationship.
So, what can we learn from CellRev's story?
So CellRev are a privately financed company, spun out of Newcastle University in 2018, and really started getting underway with our own development as an independent entity in 2019. So our clients are getting solutions that address bottlenecks in their process development that they've seen for 10 to 20 years. We're not the ones producing the sexy vaccines, producing the sexy therapies, but we are vitally important to make sure that those get through to the patients. So life science tools and technologies are ultimately the enablers that operate in that part of the value chain to make sure that these new developments, these new treatments make it through to the people that really need them. We have now opened our Series A, so to achieve that, it means we've had to validate technology, we've had to demonstrate product market fit, and we've had to show commercial traction. And that's exactly where we are now as a business, so it's a very exciting time for the company. But prior to that, yes, we've had to jump through quite a few hoops to secure the financing to allow us to actually get to where we are. We have had some very supportive investors along the way, including North Star Ventures based out of the Northeast, who have supported CellRev from spin out all the way through to our latest fundraise. They've been a fantastic support of the company. We also had a grant that was supporting the spin out process, but to complement that grant, we did also attract a couple of high net worth individuals, so a couple of angel investors who put a sum of money in alongside the grant, alongside North Star Ventures, just to really get CellRev moving. I'm not precious about protecting my role here or protecting what we've got. I'm more interested in ensuring this business scales to the highest heights and realizes its full potential. And I'm humble enough to know that maybe I won't be the person that takes it all of the way, and that's okay. And I think we've got to ask our investors to understand they might not be the investors that take it all the way either. You've always got to put the business first and the people in it. My goal is to achieve a buyout. Shareholders entrust me to come in and manage the company and grow the company to a point that it's desirable and would be acquired. That's ultimately my job. So if I do that, then that's success.
And finally, the people power of crowdfunding.
Crowdfunding can be a really useful tool to raise finance for a business.
So there are lots of different crowdfunding platforms you could look at, like Crowdfunder for social mobility projects. You've got things like Kickstarter for creative projects, Indiegogo for tech projects. There's tons and tons of different ones that you can use. So it's about knowing what your business is, what sector you're in, and what's most relevant for you. So people look at, PE, VCs, all of these other things in order to raise money and that kind of stuff. And you may get substantially more money from those people. They are likely to have deeper pockets, and that's okay. But from that crowdfunding perspective, yes, you might not be able to raise as much money, but you retain so much in terms of control, your timeline, your exit, being able to give shares to your people first before it goes to public.
For those consumer businesses, it can be so helpful as essentially a marketing tool. So what do? You might speak to a whole lot of people online. You might go, actually, at least 500 people would love to see me develop and sell this bag. And they might be your best advocates, and they might also be your future customers.
So we looked at crowdfunding. It was something I had absolutely no experience of. And I thought, well, wouldn't it be cool if our community owned these shares? And was like, okay, so we looked at a few platforms and we settled with Seedrs, which is now called Republic, I believe. And what that means is that if the community own the shares, we've then got however many advocates as well. So people are going to go out and talk about us within the profession to other people. So
it's a really wonderful way to essentially sell off sort of ownership of your business or incentivize them in some other way. It doesn't necessarily have to be selling off part of your business. When you're going to an investor down the line, if you chose to do so, that's really helpful because you can say, well, actually, we raised 250,000 online from complete strangers. So that to an investor is a huge green flag.
We wanted to raise some money because we had a few projects that we wanted to run with. And whilst we're profitable and the rest of it, we felt like that little cash boost would really help us get to the next level and get there faster. So we wanted to raise around about £150,000. That was at the kind of level that we wanted to raise at. So, and we were willing to give away 3% of our business for that. Now, the reason that we use Seedrs and the reason that it made sense for us really was because it deals with a lot of the administration. The due diligence process was wild. It was a lot of work. I guess the best way to equate it would be to say it's kind of like an MOT for your business, in that there's like so many different checkpoints. It is a really interesting process to go through, but made us an awful lot better and stronger as a business. One of the best things about the raise was that there's no pressure to exit. So never at any point have Seedrs or Republic said to us, when are we going to get our return on investment? When are you going to sell out? So if you're thinking about crowdfunding, I would say there's a number of things that you really need to consider. First is find the right platform for you. Secondly is think about the type of investors that you want to appeal to? Who is it that you're really trying to get into the hearts and minds of in order to become an investor in your business and really back your cause? And I'd say the third thing just to be aware of is that this isn't a part-time project. This is something that requires your commitment. You will need to know your business, know your numbers, know your due diligence, but at the end of it, puts you in a much, much stronger position.
So what does the future hold for finance?
Investment has become much more sophisticated, and there's a lot more capital around than there was 20 years ago. There's specialist capital for specialist types of investment. There's the CDIS and EIS schemes are growing very well. People are looking for alternative places to invest their money.
I would love to see capital flowing more readily back into early stage businesses, just really the market settling back down to reasonable levels of capital deployment.
My thoughts on the future is that it is a really exciting space within entrepreneurship as a whole. You've got AI and technology advancements that are constantly changing within the business landscape, and so it's really important that business owners stay up to date with that and that they're constantly using that innovation within their organisation.
There is an argument that to approach investment from a social impact standpoint has a huge economic return as well. For example, if you are supporting female founders who are developing products or services specifically for women or underserved customer bases, those customer bases have spending power and they're not currently served. So you're actually accessing a new market where you could generate huge amounts of revenue. So that is very much an economic and business case in black and white for why you should support underserved founders and underserved communities. It's a new market, it's a huge opportunity financially to do that.
I guess the future of crowdfunding and the way I see it is more the styles of businesses kind of like ours who have communities. So ones where they have a real loyal fan base and going to them for their next pot of money, etc., to go again. And just so those people can be so ingrained and part of that process and part of that business. If you can create a business where you've got a loyal community and a loyal fan base, then why wouldn't you want to bring them on that journey with you?
We're actually looking at companies who can demonstrate a really reliable, sustainable business model that can be profitable, that can actually generate returns for investors over a period of time. That growth at all cost has gone now, really. And so the companies that will raise finance today and sort of moving forward in the near future, they will be companies that will grow steadily but sustainably. What the UK has always had going for it is incredible universities and sort of talent pools and research areas up here. So we have a lot of research and development and innovation going for us as a country, and I think that will be reflected in our investment landscape in years to come.
As we end our journey through the future of finance, we hope you've gained a deeper insight and from all sides of the investment table. From the financial route you choose to the people you select to join you. You've seen how bootstrapping, grants, loans, equity and crowdfunding can each play a crucial role in fueling your business's expansion. As you move forward on your entrepreneurial journey, remember that growing a business may be one of the hardest things you'll ever do, but it's also one of the most rewarding. And we're not just talking about money here. It's about turning your passion and your vision into a reality, creating value and making that lasting impact on you, your family and other people. Thank you for joining us in this exploration of the future of finance. The next chapter in this exciting story is yours to write.